Good evening. I'm Michael Bender or good morning if you're watching this for a morning hearing. I am Michael Bender from the Center for Fiscal Equity. This is part 3 of our presentation on tax reform. In video, this is intended for members of Congress and the Senate and their staffs and committee staffs on the Revenue and Budget committees, and for people who want to just know more about taxes, including the advocacy community, Republicans, Democrats. And, because there are advantages to both sides of this reform plan. I'll probably talk about that in the last video. I haven't written that one down, so that'll be ad-libbed. But yeah. So the next step is the video one. Video one did the Social Security payroll tax. Number 2 did and that it's the payroll tax for OASI and DI only. It doesn't include and it may be just OASI actually. It doesn't include the other social insurance pieces. And then the second. And also the wage tax. The last presentation, number 2, was on the asset value-added tax, which replaces capital gains taxation, as well as returns from capital, taxed at a special rate, of course. So this third one, now that I've taken up a minute 48 of the time, is the subtraction value-added tax. Now these are net business receipts taxes. They're equivalent to what your employer sends in when you work. You work and your employer takes it out, or you pay if you're self-supporting. You pay estimated taxes, or self-employed rather. And that's included if you're a gig employee. You're supposed to pay estimated taxes every quarter, and they pay taxes every quarter. Employers do, and the theory behind this tax is that you don't have the employees file their taxes. Instead, the employer is responsible for both submitting and reconciling these taxes. Aside from the higher tier versions, collections of the wage, of salary surtaxes, the basic part of this tier 1, as we call it, is a tax that over the entire or tier 0 you could call it, but it's tier 1, over the entire universe of people who pay this tax, the government, when all is said and done, shouldn't collect a dime if everybody's collecting it and organized to do so, because higher people who have less deductions would than normal or credits would pay more. Those with more creditable activities would pay less, and the credits would make that first tier a wash. In other words, it doesn't matter what the rate is. To the average employee with the average number of children, if you're making under $85,000, you'll get as much as is paid on your behalf. Now, what are the exclusions? Health insurance or direct care provided by employers, in other words, if they have a doctor on staff. Employer-paid educational costs in lieu of taxes. That includes sending your kids to public or private school at either the employer or the employee's option. Remedial training for either family members or the employee. First 2 years of college, and ESL. And it also covers wages paid to students for opportunity costs. So, if you've got somebody that you're hiring and you're sending them to school, the value added you'd usually pay, you wouldn't pay that for paying them. So that's an added incentive to actually put people on in advance, and then train them up. Also, technical school, and again, ESL would be included. So if you want to bring it, and for that piece, there should be no, just as there's no requirement to report or to exclude elementary students who are undocumented. You cannot by the same token, constitutionally, I would aver, exclude people from ESL, so or from remedial, based on their immigration status. So you'd have to actually pay them and insure them. Now that's where the health insurance part comes in too. So if you insure them, that's also a credit. The most important exclusion is the refundable child tax credit. You see that in the current tax law from the American Recovery Plan Act. It's in Build Back Better. The Manchin has bullied the Democratic Party into making it just a single year reauthorization rather than a permanent one, which is, we'll make it permanent eventually, but it's really a pro-life position. Subsistence level benefits force the poor into servile labor. Wages and benefits must be high enough to provide justice and human dignity. This allows for the ending of state-administered social welfare subsidy programs and discourages abortions. That's important. If you're against abortion, you have to be for this kind of tax exclusion, or you're not really pro-life. You're just anti-sex. You're actually saying no abortion, and we're not gonna pay for the children's welfare. So or for contraception, and that's just basically being sex negative. That's not being pro-life, because this needs to be part of the issue. It has to be, because it's right. Even if there were no such thing as abortion, it's still right to pay for family size. And the thing about paying for family size is the free market can't do that. You'll just hire a bunch of childless people. So instead of hiring childless people, or hiring, there's a thing in the tech industry, experienced programmers who they have experience with coding, but they don't know the most recent language. The old saw, it's true that they fire one person who they got paid for their experience and for their kids, essentially, because it's implicit in longevity pay, and instead by two recently graduated programmers who know the current code. And one of the other things that would be a subsidy is to retrain people who need to learn the better code. So, their time would be free, and, the training costs would be paid as well as an offset. This is better than the fair tax, because in the fair tax, you pay the fair tax, and then the government distributes the money, and not enough money, just enough money to pay the fair tax, not enough to actually be an income subsidy. That's a little something the fair tax people don't like either. They don't, again, the pro-lifers among them are sex negative, which is, just not fair. Now, the other thing about this tax is that unlike an invoice value-added tax, it would not be border adjustable. Speaking of border adjustability, going back to the asset VAT, there should be a negotiated rate on that. 26% or around there internationally, so people don't game markets, because people would do that. Say, oh, don't trade in New York Stock Exchange, trade in Beijing, and it's like if everybody has the same tax rate range, you won't get that for the asset VAT. But going back to this tax, the subtraction VAT. It can also be used in later stages for personal accounts and Social Security, so that would be another offset. You wouldn't do it now because there's not enough employee ownership organizations. Back in 2001, the Center for Fiscal Equity, then called the Iowa Center for Fiscal Equity, proposed that yes, you can go ahead and have personal accounts, but they need to be in employee-owned firms. They need to, they need to be equally, and the payments need to be equally distributed, as I talked about before, for the employer side of the of payroll taxes. So yes, they didn't. Charles Grassley did not respond to my to my proposal, and the whole thing died anyway. But employee ownership is a good idea, but there's two ways to fund it. One is as an offset to the asset value-added tax, and the other is through this. That's when you have a lot of functioning employee-owned companies who will want to have that capital to invest and without having the government see it, but they would be better trustees, and it would be insured. That's the other thing, that a exclusion for retirement savings shares to employees. If you had that as an exclusion from this tax, of course you'd have a higher rate. You would take tax from invoice taxes that pay for Social Security and benefits, and you can put entire health benefits for retirees in this pool too. They can either be invoice VAT or subtraction VAT, and you'd have a higher rate, but the offsets would be higher, because again the goal for the first tier is to have remit nothing except to offset other people's credits. Because yes, if you have more kids, more old people, more workers who are saving for retirement, in that case, higher health costs, you would get money back from that payment. Currently, that payment is made on a quarterly basis for your employees. Instead, you could do this now with the child tax credit. The child tax credit, instead of being the advance credit, is now being IRS withheld or IRS paid. So that you're getting a check if you've got a child tax credit coming. Instead, the child tax credit, instead of coming at the end of the year, it would come through wages. It would be refundable. So although low wages would probably not exist under this plan eventually, but it would come through wages, and then instead of paying it to the IRS to have it pay the employees, you would just pay it to the employees. Same thing as health, and childcare too. So once those low, and the state level tax, because the states would also pay this tax, they would charge enough for the education costs, and either that would fund the schools, and also social welfare that's funded by the state. That includes the remedial and the ESL. That's probably where that would occur anyway. So you would do what the government does now. It would have to be done, but the money doesn't have to go into the leaky bucket. That's the leaky bucket theory is something in policy analysis is that if you're giving water to people, the bucket leaks because you have government action. But this plugs most of the leaks, if not all of them. So of course the theory says, even if one drop gets to them, it's still a good thing. Just a little bit of an exaggeration, or a little too far, but that's the subtraction VAT. I think I've covered it all. Yes, I have, which is good because I'm out of time. Again, I'm available to answer questions by Zoom or in person. You can. I'm sure there's an email someplace. Fiscal Equity at Yahoo Group at yahoo.com. I'll put that in the description, as well as Patreon information. Please also subscribe and share. Thank you much. See you in part 4 on invoice value-added taxes.